Hey there, traders. We're back for another daily recap for Tuesday, March 4, 2025. Another day with big swings, and it wasn't a surprise to those who had the game plan before the opening bell, courtesy of Ticks&Trades. We're looking at a daily chart of the SPY, also known as the Spiders, which is the ETF that I like to track to help inform my trades in the S&P 500 E-mini futures. So what can we say about this chart with the information that is right in front of us? First, the downtrend continues. That should be obvious. Almost 2 weeks of bearish activity, except for last Friday. That's this green up candle that we've had. So this is the first green up candle we've had since, what is this, February 19? They made a new high and they started falling from there. And if you go back and look at the recap video for Thursday, February 27, you will see that we had information leading up to the opening bell for the next day that provided clues that price was likely to go up on this day. So what was expected on Monday was that the bulls would have a good chance of maybe pulling back and then breaking up through these trend lines. That was the overhead resistance, and they could get above that area, but they couldn't do that. On Monday, the bulls got beat pretty bad, and that set the stage for today, Tuesday. So another overall down day. We're looking at today right now. But let's make some more observations. So remember the breakout area that price bounced from on Friday? That would be this zone right here. So they bounced from Friday as expected, and they got below this zone today. Well, there's another breakout area that has come into play right now. It's kind of a zone between, say, 575 and 571. It's kind of a big area, but you have this 200 period moving average below this new breakout area. You can see right here, price came up, they couldn't get above this level. They got above it. They've bounced off of this general zone. So that's exactly what happened today. They came down into this area short of the 200 period moving average. There's this black line that's kind of going up here. So where the SPY bottomed out today is a good place for them to bounce from. Like tomorrow, we could get higher prices. No guarantees that will happen. But from what I see right now, I see more than a few reasons that the bulls could try to stage a rally tomorrow. We'll have more information to go on tomorrow morning when we take into consideration what the overnight session and the futures do. But as of about 10 p.m. Eastern right now, I see the bulls wanting to try to make up some lost ground tomorrow. We need to explore all the possibilities. And since the current environment is giving us big swings and ranges, I'm going to rule out going sideways as an option. I'm not saying that they won't go sideways or go to sleep and be flat tomorrow. I'm just saying that the higher likelihood at this point in time is increased volatility. So where could price be going if the bears get the upper hand tomorrow and are able to push price down? I'll give you a zone that could be a target between 565 and 563. It's another relatively large area, this whole zone, 20-point spread or so. But where you have 120-point swings in a day, like what we've been seeing lately, then you need to expect that levels and zones of support and resistance could be wider than usual. This will make sense when we look at how the levels for today played out. So let's look at the levels and the game plan for today before jumping into the trades for today based on the levels. I would suggest that you take your time to read through the notes for today if you haven't seen them yet. There are a lot of traders out there who are following this channel who are getting the levels each morning, as you see here, and it's helping them to understand what to expect throughout each trading day. Notice this sentence here. If price gets below 580.88 and we see sustained closes below that area, that could mean the bears could pull price down more from there. That's pretty much what happened all day today. They opened below that level of 580.88 and most of the day was weak. Here is a 1-minute chart of the entire day so we can see in detail how the levels worked for today. I'd like to show two approaches to this futures trading strategy. One is if you were to trade each level on the board each day according to a set of rules. This is designed to show the effectiveness of following a specific process each day. The other approach is to track the actual trades that I take each day, which are more in line with what I feel is the general sentiment of the market for the day. The levels are still important, but I may not trade each level depending on what I see going on in real time, or if I actually have time to trade at all. For today, as we'll see later in the recording of the live trade that I took in the morning, it's a combination of what I'm seeing in real time, along with my preference to trade during the first part of the open session. I rarely trade in the afternoon. Many times, I'll just grab a single decent trade right after the opening bell and then close up shop for the rest of the day. It's just a process that works for me. I prefer quality trades over a lot of maybe average trades, but I digress. So here is what would have happened if you traded each level from the morning exactly as the rules dictate. Trade number one was a long trade when the SPY hit 576.01. That's the level from the morning, 575.96, with 5 cents added to the level. When price is coming down into 575.96, you would trigger the trade, a long trade, at 576.01. It's really not necessary to do that in a fast-moving market, but it helps sometimes in a normal market because it pulls you into more trades when there are front runners who might want to make the market move ahead of the level, if that makes sense. But anyway, this long trade here at this level did not work, and you would have reversed at the max loss limit. That's a 20-point loss and at least a 4-point gain on that reversal as price continued to fall. Didn't start the day out very well, but trade number 2 was a short trade at the same level. We're going to adjust the price, adjust the level toward price, so 575.91. Going short there would have given you a very easy and quick base hit, at least 4 points. We're just assuming a 4-point base hit at every level, so the tracking log for this approach is consistent. So this level at 575.96 is now off the table for any other trades during the day, during this day at least, whether on the long side or the short side, because it has been satisfied both times. Trade number 3 was a short trade at 580.83. That's 5 cents toward price. They hit it to the penny, 580.83, and pull back more than 40 cents. So there's your 4 points in the E-minis. Another good example of why that 5 cent buffer or adjustment is important. Like if you sold your ES contracts the moment the SPY hit 580.88 right here, it would not have worked out. But with that 5 cent buffer, you got in at the right price, to the penny. Trade number 4 was a recycle of this same level, this time on the long side, going long at 580.93. We're adding 5 cents to it, so right up here somewhere. That's the operating level where the futures trade was triggered, and it was a quick base hit of at least 4 points, more if you were willing to hold it. Trade number 5 was when the SPY hit 583.71. You would have went short in the E-minis and pulled 4 points or more when they pulled away from that level. So overall, you would have given a few points back to the market today if all you pulled was 4 points for each of these base hits, because that first trade, that TKO, that technical knockout, that max loss limit, put you behind the curve early in the day. What you could have done instead, if you saw price under 580.88, if you had that intel from the morning, because I said that if price got under that level, the bears were more likely to push price down farther. That's what was spelled out in the game plan from before the opening bell. So would you have been willing to jump on board and ride this thing down a bit early in the morning? That's what I did. This is a recording of one quick trade that I took this morning. Like yesterday, I had back-to-back meetings all morning. So I was not planning to get involved in the market, but I finished up early from one of the meetings. It was about 9:50, right before 9:50 a.m. I got back to my computer. I saw what was going on. Price was under this 580.88 and falling. I jumped on board on the short side, expecting price to go down farther. And I had another meeting at 10 a.m., so I really didn't have a lot of time. But I managed to squeeze 17 points in a few minutes. I'm going to start playing this. It's not very long, just about 30 seconds or so. So as I said, I was already in this trade. It sped up until right before I closed out the profit. It happens fast, so I left the recording at real time. You'll see in a moment it kind of slows back down to real time. So I'll let you watch the whole thing. And since I needed to get out of this trade quickly, I kept moving the profit target up, toward where current price was. So I got out right at 17 points. So I stopped the recording shortly after that, right here, 9:54, 9:55 or so, and I was busy for the rest of the day. So this was short and sweet, and it was worth the risk. By the way, you could ask yourself which you think is easier, trading each level like a robot without regard to the bigger picture, or choosing to get into only the high probability trades, which tend to happen early after the opening bell. Oftentimes, I just grab one good trade early on, and then I'm done for the day. So when you look at the metrics of these two tracking logs, just consider that approach, which, what you think might be a little bit easier and less stressful. This first log, the play in by the rules log, or PBR for short, 5 total trades. You can read the notes, and at the end of the day, you would have ended in the red a little. And then my trade over here on the Sam's Trades, one easy trade I took. I jumped on board when the SPY was right here, pulled that 17 points at $1,700 with the 2 contracts. Not much more to say about that, although I'm going to go ahead and scroll up so you can see the other trades for the year so far. January and February. There's a lot of green in here. Almost all of these are early morning trades. Rarely are there trades that happen after 11 a.m. Eastern or so. And if you've been following along, you've seen most of these trades in this Sam's Trades output because I record most of them. And back to this PBR, if I scroll up previous 2 months, you can see that there's a lot more fumbles and TKOs, technical knockouts. That's like max loss limits or 2 fumbles in a row. So basically more bad trades or less than desirable trades like today. And this is not just because there are afternoon trades. It's because if each level is traded indiscriminately, without regard to what price action is telling you in real time where the market might be going, there is simply a higher chance of trades not working out. What I'm trying to convey here is that once you have a handle on how to read the market and interpret the signals, you'll have better trades because you'll learn to take only the high probability ones. The course that I've developed focuses on this sort of thing. And by the way, we're on the home stretch for this thing finally. If you've signed up on the Ticks&Trades website to get updates and to receive the daily levels, you'll be getting a communication soon with behind-the-scenes info about the course. It will be live soon. If you want to get on that list, by the way, just head over to Ticks&Trades.com and sign up. I'll be happy to add you to the VIP list. With that said, this is a wrap for today. I hope you found some value in today's recap. Thanks for watching, liking, and subscribing. I'll talk to you soon. Have a great day.